Hey everyone, I recently came across an interview of Mr. Ramdev Agrawal and he shared a simple calculation to create a 100-bagger portfolio. He said that you need 25% CAGR return to create a 100-bagger portfolio in just 20 years. And if you do the math, it is actually true. So let's say you have a portfolio of 10 lakh rupee and you can get 25% CAGR return. Then in 3 years, it would almost double to 19.5 lakh rupee. At this rate, in 10 years, your 10 lakh would become 93 lakh. That's nearly 1 crore. So almost 10 times return in 10 years. And if the same amount is kept for 20 years at 25% rate, it would be worth 8.67 crore. That's nearly 100 times return. Actually, to touch the exact mark of 100 times return, that is, if you want 10 lakh to become 10 crore, you would need a precise return of 25.9%. So math clearly suggests that at 25-26% CAGR, it's possible to double your wealth in 3 years, 10 times in 10 years and build a 100 times portfolio in 20 years. But the key question here is it really possible to generate 25% return in the portfolio for 10-20 years? Now this is what I want to discuss. I wish it was that easy to fetch 25% CAGR in 10-20 years. There are a few companies that have doubled investor wealth in every 3 years and generated 100 times return in last 20 years. One name I could think of is Asian Paints. It was at 39 rupee in 2005. Today it is at more than 3000 levels. Another name is Pidilite. It was at 20 rupee in 2005. Today it is at more than 3000. Then third name that strikes my mind is Titan. It was at 12 rupee in 2005. Today it is at more than 3100. That's more than 300 times return. But the fact is that you can actually count such 100 baggers at your fingertips. And this is out of more than 5,000 companies that are listed in Indian stock market. Now when you build a portfolio, you can't just invest in 1 or 2 companies. Obviously that's a huge risk. Plus there's no guarantee that 1 or 2 companies that you have selected would create 100 times return. So you would have at least 15, 20, 25 stocks in your portfolio. Now there can be a case where 1 or 2 stocks from your portfolio becomes 100 bagger, like your Titan, Asian Paints. But you can't expect your entire portfolio to compound at 25% rate to become 100 times in 20 years. That is next to impossible. You'll always have a few stocks that would underperform and few would generate just average returns. So net, you might end up with say 15-16% kind of return. That too if you have invested in fundamentally strong companies at right valuation. By the way, 15% return is also great. At this rate, your wealth would double in 5 years. In 10 years, it would grow 4 times. In 15 years, it would be 8 times. And in 20 years, it would be 16 times. So you need to set the expectation right. The problem is that today, majority of people have started their journey in last 3-4 years after COVID. And they have not seen a major correction. The kind of return market has generated in last few years, it looks like you can double your wealth in just a few days. But trust me, in the long run, it is impossible to fetch such high returns. It just reminds me of one quote from Mr. Rakesh Jhunjhunwala. He says that if you are able to earn an 18% return on your portfolio, you are no less than a king. And if the return is 21%, you are an emperor. So we need to set the expectations right. 25% CAGR for 20 years can certainly fetch you 100 bagger portfolio, but how many people would really end up with such returns? There are hardly a few people. Another problem in building a 100 bagger portfolio is handling volatility. While math does suggest that you can fetch 100 times return in 20 years at 25% CAGR, but stock market returns are not that simple. While you can see your portfolio going up by 200% in a bull period, it can fall 50% in a bear market. There's no stock that only goes up. Even 100 baggers like Asian Paint, Titan, Pidilite have corrected 40, 50, 60% in the past. Okay, just imagine you invested in a potential 100 bagger company and it generated say 5 times return in next 3 years. But due to correction, the stock fell down let's say 30-40% over the next 6 months. Now your returns are just 3 times. Tell me honestly, will you have the courage to hold it? Your first thought would be to book that 3 times profit before the stock goes down further. And majority of people would end up booking profit. So it's extremely difficult to keep that conviction in a company even if it has 100 bagger potential. We keep hearing stories about Rupees X invested in Infosys, Wipro, Eicher Motor 20-30 years ago would have made you a crorepati. But how many people really become crorepati by holding these stocks? Hence, it's very important to be practical and set the right expectations. Indian stock market has compounded at 13-14% in last 25 years. And I believe that Indian markets can continue to grow at this rate over the next 25 years. So even if you pick great companies and beat the market, you can expect 15-16% kind of return. Yes, there will be exceptions where some people can outperform the market with a bigger alpha. But this return expectation of 15-16% is for majority of people. But for that also remember that you need to invest in fundamentally strong companies at fair valuation. If you end up investing in overhyped companies at expensive valuation, it won't end well. So as far as 100x portfolio is concerned, I think it's more of a marketing gimmick. I'm not saying that Ramdev sir is wrong, but all I'm saying is that majority of retail investors, it's not possible to create such wealth with initial capital. So if you expect that today you build 10 lakh portfolio and it will fetch 10 crore return, it would be too much of expectation in my opinion. Yes, if you keep earning and keep investing that incremental capital, then you can certainly reach 100 times of your initial investment. That is the only recipe to make a 100x portfolio. Keep earning and keep investing the incremental money. So you need to set your expectations right. There's no magic formula that can generate 100 times return. Having said this, I strongly believe that equity is the best asset class to create wealth. Yes, if you are building a stock portfolio by yourself, it would require a lot of knowledge and research to identify the right set of companies at fair valuation. And then you need a lot of patience and conviction to ride your winners. Plus, you would need to closely track the performance. If you don't want to take that hassle, you can always consider taking index fund or active mutual fund route. I always say that for someone who has started his or her investment journey, it's better to go with mutual fund route. Have majority of exposure in mutual funds, and if you're fascinated with stock market, you can keep a small allocation of say 10-20% in stocks to begin with. Then slowly build knowledge and experience over the next few years in stock market, and then decide if you're comfortable with individual stock investment or not. If the answer is yes, then you can increase allocation in individual stocks. But for a person with a job or business who does not get enough time for stock investment and research, it's always better to keep higher allocation in index funds or a combination of index funds and active mutual funds. And you can always have some allocation in individual stocks. Okay, I don't want to stress this video further. The reason behind this video was to share the truth with you all. These days I come across a lot of videos or reels where people sell fake dreams to make huge wealth. And many people actually fall for greed. But remember that stock market is not a magic machine that can double your wealth in no time. So if you know someone in your friend circle who has recently started the investment journey, do share this video because it's very important to set the right expectation from stock market. Those who keep the wrong expectation of multi-bagger returns in no time would eventually end up with loss. And the biggest culprit here is greed. Majority of new investors in stock market have no clue about how the stock market works and how to identify fundamentally strong companies. In fact, majority of them try to chase the hot themes, especially when the stocks have already become expensive. So it's very important to learn the art of stock picking. I always say that it's not just about returns, it's about risk-adjusted returns. In case you're a long-term investor and looking for right knowledge to build a portfolio for long-term wealth creation, you can explore my weekly video series where I share one exclusive video every week. It includes my own top conviction stock ideas where I'm investing my own money along with reason behind the same. I also track more than 200 quarter results that helps in identifying great investment opportunities. Again, the idea is to share my knowledge and not to give buy-sell tip. For more detail, you can explore my website or join button of this channel. If you have any query, let me know in the comments. I'll see you next video. Till then, take care.